Hey there everyone, it's JP from the Letnick Estates Group. Today we're going to be talking about mortgage deferrals during this epidemic, the COVID-19, whether or not this is a good idea and if you should do it and how it's going to affect you. So I'm located in Canada, and the big banks here have announced in late March that they're going to allow a mortgage deferral of around 3 to 6 months. Now, each bank is different, and what they're offering is going to vary per person. So what you should do if you're really looking into this as an option, if your income has significantly declined, is you should go and speak to your bank. On social media right now, we're seeing a lot of people claiming that mortgage payments are going to be frozen and thus renters should also have their rent payments frozen. And this information is very, very misleading. And unfortunately, it's giving a lot of false hope to a lot of people. But mortgage payments are not being frozen. So we're getting a 3 to 6 month deferral on mortgage payments. And what this means for a lot of people, and there's different variations depending on your situation and your bank. So if you have any questions about mortgage deferrals, please contact your bank. Hopefully you can get through. I know I tried contacting them for over a week and I couldn't even get through to anyone to speak to ask any questions. So if you are going to be looking at this as an option, keep at it and hopefully you get through. So here's what it breaks down to. So let's assume your mortgage is $500,000. So what you're going to have is a blended payment typically of interest payment and principal payment. So your principal is the amount that you're paying down on the amount that you borrowed. The interest is the amount that is being charged basically for you to have access to that money for your house. So what you're doing every month is you're paying a blended amount normally. Now, there are different situations where you might be paying interest only if it's a home equity line of credit, or if you have a variable or fixed rate, you may be able to also lock in part of that as a fixed rate mortgage and also have an interest only portion. It really depends on what your situation is. Now, what we're also finding is that the banks are typically, in most cases, only allowing the mortgage deferrals on principal residence. That means you have to actually be living in your property. Most of the banks are not allowing these deferrals on income-producing properties, so rental properties. There are some situations where this is the case, but typically it's not. So it's very important for you, again, to speak with your bank and find out the information on that situation itself. Now, the situation here is that if you are getting a mortgage deferral for 3 to 6 months, however many months that is, your interest and principal payments that you would have normally had to pay, you no longer have to pay it during that time. What happens in most cases is that your interest that you would have had to have paid builds up. It gets added into the principal amount that you had originally borrowed. So let's say your mortgage is $500,000 and you're paying a monthly, let's say, interest portion of $1,300 roughly. And what that happens is over 3 to 6 months, that amount will build up. Now you're at $500,000 plus the interest that you deferred. So if that's 3 or 6 months of interest, that's what you add on to your amount. So your $500,000 plus interest that you could have paid. So your bank is going to be wanting that to be paid back in a variety of different ways. Now, most of the situations is that it's just going to be added to your principal and you're going to just have to pay that off over the rest of the course of the mortgage. So if you have a 25-year mortgage, you're going to be having an extra payment on top of your regular payment. So it could be, usually in that situation, it's around $30 to $35 per month. It, again, depends on your interest and how many months you deferred. So make sure you do that calculation, get the details from your bank. But we're seeing that for most of the average $400,000 to $500,000 mortgage, if you're deferring for 3 to 6 months, the interest amount that's being added, and keep in mind, it's going to be compounded over the next 25 years of amortization. It's getting calculated, and your extra payment for the remainder months is about $30, $35 per month. So over the course of that time, it works out to be a lot more than what you would have had to pay interest-wise, because that interest is being added right now, and you're paying it off over 25 years. So you have compound interest on the interest that you deferred. Another thing to look out for is your credit score. Now, a lot of banks are saying this will not affect your credit score. It's a deferred payment, not a skipped payment. The issue here is that often what happens is that you're speaking to a representative on the phone who knows nothing about the actual processes with credit scores.
I don't understand. I made a reservation. Do you have my reservation?
Yes, we do. Unfortunately, we ran out of cars.
But the reservation keeps the car here. That's why you have the reservation.
I know why we have reservations.
I don't think you do.
What the credit scores are calculated on is typically like Equifax. They will get an automated system report from the banks that these representatives have no control over, And what happens is that it shows to Equifax, oh, this payment was deferred. In some cases, it may report automatically to agencies like Equifax that it's almost the same as a skipped payment. So we don't really know 100% right now whether or not your bank specifically will be doing the deferral and reporting it as a skip payment or a deferred payment, and if it will or will not affect your credit score. So best idea is, if you can make your payments, continue making your payments, and that way you don't have the risk of hitting your credit score. Because making a skip payment or a deferred payment, if it does affect your credit score, it can bring you down a fair bit. It's not something that you want to have on showing on your report for the next 7 years before it gets scrubbed off. So another situation that we're seeing is that some banks are deferring your payments. And that's great. 3 to 6 months, no payments, awesome. You can kind of get your things back in order, reduce your expenses, and get back on track. The issue on some of these cases is that the banks are, in some situations, not all, are asking you to pay back the entire amount of interest that you deferred at the end of the deferral payment period. So let's say, for example, you deferred for 3 months. Well, on the 4th month, now the banks want you to repay month 1, month 2, month 3, and month 4 that you owe of the interest payments that you would have deferred. So in this situation, now you're going to get hit with a big bill of a few $1,000s typically, and you're going to have to come up with that money. Now, in some situations, you may be able to talk to them and work out a payment plan for this, but in some cases, you're going to be hit with a big bill that you might not be able to pay, and in some situations, there's going to be some foreclosures because you're defaulting on your mortgage in that situation. So it's really important to know that this isn't just a free ride. You do need to actually figure out whether or not this is going to be a good option for you. Now, there is one more situation that I've heard. I haven't been able to really verify if this is true or not, but some people have been saying that they've been able to get their mortgage payments deferred and added on as months to the amortization period. So instead of, let's say you just got a mortgage and it's 25 years, you now have 25 years plus 3 or 6 months deferrals of however much you did. So in that situation, it's a little bit different, but you're basically still in the same boat before, where you are going to be having to pay that interest, and it is going to be compounded. So your payments technically are going up a little bit. That is still an option. What we are hearing, though, from this situation is that the payments might not even increase. It's just that they're adding on some extra months onto your amortization period. So it lengthens out the amortization period. Your amount is higher, but the interest payment is the same every single month moving forward, because they've added an extra amount of time to the amortization period. That I haven't been able to confirm yet, so it's something, again, it's very important to double check with your bank just to make sure that which situation you're going to be in and whether or not you can even qualify for this type of exemption. So this situation isn't for everybody, but let's say, for example, you're running your own business and you've had to close down, or you've lost your job, or maybe you had tenants and they had to move away, or they're not paying you rent, and you're really having a hard time with the income, that cash flow that's coming in. This might be a good option for you. However, if you do have savings and you're able to make your regular payments, it's probably in the best interest for yourself to just continue making your payments. Also check and see if you qualify for any of the emergency fund government-run programs that are coming out, where even for self-employed business owners who don't qualify for typical EI, there may still be a program for you. So double check on the CRA website to see if you can get some extra cash flow coming in to subsidize that and make sure that you can still pay your mortgage payments, because this could very well be a big influx of people that are not able to make their payments, get deferrals, can't pay out the deferral program after that even also, and then on top of that may have to foreclose or default on their mortgages, and then we're just going to see a whole bunch of people losing their homes. This is not something we want to see. So if you're not in that situation yet and you can make your payments, it's very important to try and make your payments. That way you're taking care of yourself and your family and your home. So hopefully this information was helpful for you. If you have any questions, let me know. If you want to see any other future videos, feel free to let me know in the comments section down below. And please remember to hit the like and subscribe button, especially the like button, as it helps the YouTube channel algorithm out. I would greatly appreciate that. And again, my name is JP from the Letnick Estates Group, and we'll see you on the next video.